Yeah, the economy is fragile right now. It's
Mm.
so fragile that you don't need a ton of bite to really kind of make things go over the cliff, right? If you're 5 feet from the cliff, a little kid's not going to push you off. But if you're right at the very edge, even the most calmest of winds could push you over. Because one of the weirdest things is that although a lot of the trade damage has been unwound and trade tensions are simmering down, we actually have zero, a big fat zero trade deals signed so far. China's gonna do AI no matter what. Like, it doesn't matter if we sell them chips or if we don't sell them chips. Like, they're gonna figure it out. They have the manufacturing capacity to do it.
Welcome back to Being Exponential with Luke Lango, where we'll cover the economy, the markets, technology, and lifestyle, all from an exponential perspective. I'm Brooke, your host. It is June 2nd. Let's dive right in. All right, Luke, the boogeyman is back at it again. I am talking about tariffs for the third week in a row. The weekend brought in some crazy news. The courts ruled them illegal, but even still, Trump instilled 50% tariffs on steel and aluminum. I know you
Mhm.
said the trade war it's not real, but you gotta talk to us about this updated news.
Yeah. I mean, just when I started to say the trade war should be put in the rearview mirror and is something the market shouldn't worry about, we have a series of radical developments on the trade front, and the market started to care about them. We careened lower last week because it was a yo-yo situation, right? On Wednesday night, I believe it was Wednesday night, the U.S. International Trade Court ruled that Trump issuing tariffs under IEEPA, one of the measures that he used to issue the tariffs. All the tariffs issued under IEEPA are illegal. Okay,
Mhm.
that's the vast majority of tariffs out there. Not all the tariffs, steel tariffs, aluminum tariffs, sectoral tariffs, not issued under IEEPA. But all those Liberation Day tariffs that really freaked out the market, those reciprocal tariffs, the 145% on China, the 10% baseline reciprocal tariff, the fentanyl tariffs on Canada, Mexico, and China. So the vast majority, I think over 2/3 of the tariffs Trump has issued so far in 2025 were issued through IEEPA. So Wednesday night, courts come out and say illegal. All those tariffs, the vast majority of tariffs Trump has issued in 2025, are illegal and need to be removed immediately. So markets rallied big on Thursday on this idea that it looked like 2/3 of the tariffs that Trump has issued so far this year are going to immediately be removed and stay sidelined until this whole legislative process concluded, which it can take 12 to 24 months. It goes through the appeals
Right.
court, maybe it goes to the Supreme Court, et cetera, et cetera. So markets had this big rally on Thursday morning because if you remove all those tariffs, you remove the reciprocals, you remove that 10% baseline, you remove the fentanyl stuff, the average effective tariff rate in the U.S. drops from we were at 3% in 2024. We jumped to 30% in right after Liberation Day. We've been moving lower ever since. Early last week, we fell to about 13%. If you remove all the tariffs the court said were illegal, then we fall back to 6%, which is really, I mean, we've round tripped back almost fully back to that 3% level we were at before any of this trade war stuff started. So markets really rallied on this idea that yes, we are finally moving in or pushing the trade war into the rearview mirror. But the appeals court came out and said we're going to allow the tariffs to stay in place while we move through this legislative process. So all of a sudden, markets cheered, woohoo, all these tariffs are going away. Never mind, just kidding. Rally
Mhm.
unwound. And then on Friday, Trump, I don't know if it was sort of giving the middle finger to the courts or what it may be. But then he's like, you know what, 25% on steel? Nah, that's too low. We're going to 50%. So then he ups the
50%.
ante. There's also the fact that, the TACO acronym has been making its rounds on Wall
Right.
Street. Trump always chickens out. He thinks it's nasty. He doesn't like it at all. So he may be purposefully not chickening out. He may be purposely swinging the club in the other direction, hard in the other direction, harder than he would want to, just to offset that taco acronym. So it does seem like, yes, the gloves are back on. Oh, Trump also tweeted and said China totally violated their trade agreement, and then China fired back over the weekend, and now they're going back and forth. I think Trump and Xi are going to talk this week. Hopefully they hash it out. But it does certainly feel like the gloves are back on in the trade war. I think Europe said that if talks don't progress further, they're going to come through with bigger retaliatory measures as well. So across the globe, EU, America, the courts in America, China, they all got their gloves on now. That's what it feels like. So markets reacted negatively to that. But when you really look at the price action on Wall Street, it's not that bad. I mean, we dropped like 2% on the S&P, and this morning we opened lower. This is Monday morning, June 2nd, and now we're basically back at the flat line. We've rebounded. Because again, I do think that there's going to be a lot of bark here, but the trade war is 95, 96, 97% bark and, 3 to 5% bite. And if that remains true, the economy can manage through 3 to 5% bite. The economy can manage through, I think the average effective tariff rate, it's 13% now that all those tariffs are back, but I think we settle around that like 6% to 13% range, right around 10%, call it, right in the middle, 9, 10%. That's totally manageable for the economy. That's totally manageable for markets. That's totally manageable for consumer spending. And so I think if we can settle around there, yes, I continue to believe the trade war should be in the rearview mirror for medium to long-term investors. On a week-to-week basis, it will create volatility and gyrations. But I think even on a month-to-month basis, it'll drown out. It'll just be noise. I think every tariff-induced dip that we see in the market going forward will be a buying opportunity. I think we're going to get quite a few of them because gloves are back on, but I think all of them will be great buying opportunities because beyond that trade war noise, there is a lot of positive things happening in the secular growth arenas of artificial intelligence, of quantum computing, it's all of these autonomous driving, robotics, eVTOL aircraft. These growth narratives are gaining a lot of steam right now. That's what really matters. That stuff has legs. It has 2-year legs, 5-year legs, 10-year legs. This trade war stuff to me has week-to-week legs, if that. And I think ultimately we settle around levels that are totally manageable for the economy. So that's where I stand on it. I understand that the markets got a little jittery and there's been a lot of developments, but I maintain the belief that the trade war from an investment perspective, investment analysis perspective, should be in the rearview mirror, and we should not focus on it when identifying opportunities in the market. Rather, we should be using that volatility to help us identify longer term opportunities.
Gotcha. Speaking of all bark, no bite, I can't help but mention the GDP numbers that just came out for Q1.
Right.
And they are at their lowest since 2022, which we know is a pretty infamous year. So how do we square these positive tech developments with, the hard, cold numbers?
Yeah, right. So that's the big concern, right? The big concern is that I think most people recognize the trade war is most bark, no, or a lot of bark, not a lot of bite.
Right.
But because the economy is in such a fragile state, I mean, if you look at any of the data, consumer confidence weak, business confidence weak, the Q1 GDP numbers minus 0.2% was the print. Personal consumption, which is the number you really want to look at, because the negative GDP print was was skewed by a lot of like export data that was impacted by the sudden announcement of tariffs. If you back that out and just look at the regular personal consumption index in there, that was still weak. That was 1.2%, which is one of the weaker levels in the last 10 to 20 years. So the economy is fragile right now. It's so fragile that you don't need a ton of bite to really kind of make things go over the cliff, right? If you're 5 feet from the cliff, a little kid's not going to push you off. But if you're right at the very edge, even the most calmest of winds could push you over. And so that's what people are worried about, is we are so close to the cliff that even something marginally negative could push us into the abyss. But I think that we got to the cliff. We got to the edge of the cliff. We got to 1.2% personal consumption growth in Q1. We got to negative 0.2% GDP. We got to these really low consumer confidence numbers because of almost exclusively because of the trade war. And as
Mhm.
soon as those headwinds ease, a lot of that data is going to rebound. We're already seeing that in the consumer confidence numbers, whether it's the University of Michigan numbers or the Conference Board numbers, both of them crashed to multi-year 10, 20, 15-year lows in April. And then in May, they rebounded in one of their biggest single month rebounds ever because of easing trade war tension. So that kind of shows you that, hey, yeah, consumer confidence is a leading indicator of a lot of things. The rebound we're seeing there is the rebound I think we'll see in a lot of the other data because, again, it's a unique situation where it was a self inflicted wound that got us to the cliff. Nothing pushed us, we walked ourselves to the cliff and we can walk ourselves back. And I think we are walking ourselves back. Again, it's a little concerning that, people are putting gloves back on in the trade war, Trump and the judges and the European Union and China. But I think they're all going to talk. I think they're going to hash out deals. It's all chest puffing. It's all political theater. And, ultimately, trade war tensions will continue to ease. Tariff rates will continue to come down. And the economic data that has been pushing lower will continue to rebound. So that's how I'm looking at the economy. And I think as a result of that, what will really help a lot of that is, the tech trends that we are talking about. You talk to anybody in artificial intelligence, and they're not concerned about trade war noise. You talk to anybody working on quantum computing right now, and they're not worried about trade war noise. You talk to somebody that's building those eVTOL aircrafts that are going to launch in the Middle East, in the next 12 months, and they're not really worried about trade war noise. You go to those conference calls with the companies working in this space. Nah, I mean, tariffs get mentioned every once in a while, but not dramatically. I mean, Nvidia talked a lot about export controls because they sell a lot to China, so that impacts their business. But even absent that, they were still able to report blockbuster numbers. So these growth narratives are durable and resilient, and that's going to help push us back to a state of exceptionally solid growth over the next 3 to 4 quarters. At least that's how I'm looking at it. So that's how I'm squaring the bad economic data with the positive tech developments and positive other developments I'm seeing in the market. The bad economic data is solely the cause of a self-inflicted trade war wound that we are now uninflicting. And as we uninflict, the economic data, the economic trends, all that stuff will get a heck of a lot better. And the market seems to think that too. We are 2, 3, 4% from all-time highs. When we were getting that negative GDP print in early 2022, we were in the early stages of a 20, 25, 30% drawdown in stocks. We got negative GDP now, and we're only 2 to 3% from all-time highs. So the market seems to be looking past that negative GDP on the understanding that what I just said is probably going to come back is probably true.
Gotcha. And I couldn't help but think. You remember when we were kids? They say, words can't hurt you. Bounce off of you like rubber. But it's funny in light of the Taco Town news that words could probably hurt the market. I think that's pretty funny.
I think words can hurt the market in the short term, right? Sticks and stones are
Yeah,
break my bones, so words will never hurt me. Words will hurt the market in the short term, but you need sticks and stones to really cause damage to this market.
of course.
Durable, long term, even medium term damage, multi-week, multi-month damage. Like I said, I think you'll get multiple days of weakness because of trade war talk, but nothing that spans more than 3 or 4 trading sessions. I think
Right.
on a multi-week, multi-month basis, you are going to need sticks and stones to break the market's bones. And I just don't think you're going to get those because I do believe the administration brought out sticks and stones on April 2nd and they saw what that looked like.
Right.
Looked horrible. You had the markets crashing in one of their fastest crashes ever. You had consumer confidence plunging in one of its fastest plunges ever. You had business confidence plunging in one of its fastest plunges ever. So, I mean, they saw what it looked like. They broke bones. They brought sticks and stones. They broke bones, and it was ugly. They realized that. So now they're putting sticks and stones back in the closet. And yes, every once in a while, you're going to get some chest puffing and political theater and all that stuff, but I don't think they're going to bring out the sticks and stones again. And unless they do bring out the sticks and stones, we can't, again, going back to this idea, put the trade war behind us from an investment and from an investment perspective.
Gotcha. Speaking of April and that particular dip, I want to dive into the markets a little bit more regarding the recovery rally that happened in April to mid-May. Over the past 2 weeks, it looks like it's flatlined. How do you foresee the markets going for the rest of the summer now that we are essentially in summer?
Yeah, so we had the V-shaped recovery off the April lows, and then now since about May 13th, 14th, we've kind of just been flatlining about 2 to 3% from all-time highs. I'm not concerned by that action at all. I think it's the market taking a breather. Basically what happened is all the damage or the proposed damage from the post-Liberation Day shock got unwound. So all the price damage got unwound as well, and now we're back to where we were. In order to propel us higher, we're going to need more positive developments, either that economic data does turn around. We do get some official trade deals launched, because one of the weirdest things is that although a lot of the trade damage has been unwound and trade tensions are simmering down, we actually have zero, a big fat zero trade deal signed so far. There
Hmm.
hasn't been one real trade deal signed yet. We went out and announced something, between the US and the UK, but there was no binding agreement signed in that announcement. We announced something with China, but there was no binding agreement with that announcement. And then there hasn't been anything with any other country. There's been zero trade deals announced so far. And as a result of that, it's kind of like, well, we need some real trade deals to get this market going higher. We need the economy to actually turn around in data to get this market going higher. We need the next earnings season to show that consumer spending trends are shoring up or improving. That tariff impact on margins for companies are being mitigated. That companies are able to successfully walk around them or avoiding them, or they've disappeared altogether. So we need that next catalyst to show up. Maybe the Fed comes to the rescue and cuts interest rates. But the point is there are a lot of potential catalysts on the sidelines. We get real trade deals signed, tariff rates go lower. That's one potential catalyst. The economy does rebound, consumer confidence does rebound, consumer spending does come back. All that ugly economic data improves. That's another potential catalyst. The next earnings season in July, August is fantastic, much better than feared. Companies stop talking about tariffs as much. They stop talking about trade war noise, and they start to say, wait, the economy is actually getting better. People are bouncing back. Consumers are spending again. We're investing again. We're not seeing much tariff hit on our margins anymore. We're not going to hike prices, et cetera, et cetera, et cetera. That's another potential catalyst. So you have a lot of potential. Number four, the Fed comes in and cuts interest rates because the trade war noise simmers down. So there are a lot of potential catalysts on the sidelines, with the common denominator amongst them. The common theme is that if the trade war continues to fade into the background, a lot of these catalysts could emerge kind of one after the other like dominoes. The Fed's not cutting rates because of the trade war. They're worried about what the trade war may do for inflation. If the trade war goes away, all of a sudden the Fed enters the rate cut game again. The economic data is weak, like we said, because of the trade war. If the trade war fades, the economic data could get a lot better. Earnings were strong in Q1, but a lot of the commentary was mixed and even negative because of the trade war. If the trade war fades, then a lot of that commentary is going to be not mixed, probably positive in those summer calls in July and August. So again, a lot of things could emerge, a lot of positive catalysts could emerge for the markets over the next few months if the trade war stuff does continue to simmer down. And I think that's exactly what will happen. Now, if we look at the technicals on the market, which, as a lot of you know, I love to look at the technicals. I'm going to screen share my technical look on the S&P 500. So this is the S&P 500 going back to late 22. I got the MAs, the 20 in pink, the 50 in green, the 100 in blue, and the 200 in yellow. Got my RSI down here. Got my MACD down here. You can see we've been in a solid uptrend channel ever since the lows from that 2022 bear market. Got pretty much the bottom side of the channel with that flash crash in April, the trade war crash. Real strong support down here at that bottom from April. Boom, V bounce, retook all the MAs. As far as what this consolidation is okay, we bounced all the way back, retook basically all of this. This is the trade war losses, right? We retook all of them. Okay. We got to a level where the RSI was basically overbought. 69.96, I think we were at, was the high. So we can call that overbought. Overbought's above 70. MACD got really blown out in a positive direction, pretty much as high as it's been in this bull market. Okay, very natural point to consolidate. So we consolidate after getting overbought on RSI, really blown out on MACD, and having recovered all of the MAs plus all of the trade war losses. Very natural point to consolidate. Importantly, in this consolidation, we haven't lost any MA. We bounced down to the essentially convergence of the 20, the 200, and the 100-day moving averages, and then we bounced right off them, and now we're staying above all the MAs. The RSI is not crashing. We got down to 56, didn't even break below 50, and we're staying high. The MACD, a little bit of a bearish crossover, but not really, kind of a flat line more than anything. So there's nothing in this technical data that tells me this is a consolidation before a breakdown, but rather a consolidation after a massive breakout and before the breakout resumes. So fundamentally and technically, I like what I'm seeing in the market. I think we do blast a lot higher into and throughout the summer. I think June, July, August are going to be great months for the market.
Fantastic news. Regarding the market and stocks that almost can ignore the trade war, I want to talk about Nvidia. They dropped their Q1 earnings, and you wrote about it. You said it was stellar. You said it was amazing, and that it's a rising tide that essentially raises all boats for the market, the AI market specifically. Can you expand on that?
Yeah, so Nvidia's numbers were fantastic, I think. Let me get my notes on them right here. Uh, the big thing is that the export controls. So, long story short, I mean, I'm sure a lot of you guys know the story, but the United States is worried about the AI arms race, and Nvidia sells a lot of chips to our biggest competitor in the AI arms race, China. So the U.S. is restricting how many chips that Nvidia can sell to China. Okay, makes some sense, right? And that's hurting Nvidia's business because they sell a lot to China. So I think they said it was going to cost them, or it did cost them $2.5 billion in revenues in this quarter, and then this coming quarter, it's going to cost them an estimated $8 billion in sales. So a big hit. I mean, over $10 billion in throughout 2 quarters in sales because of the export controls. If you back out those export controls, which is an unnatural headwind that they can't control,
Mhm.
the growth story in Nvidia is proving so durable, so impressively durable. It's actually ridiculous. So in the fourth quarter, I think revenues rose about 78%. In the first quarter, the quarter they just reported, if you exclude that $2.5 billion they lost because of the chip controls, revenues rose 79%. And in Q2, their guide, if you backed out that $8 billion that they're losing from the chip controls, revenues are going to rise 76%. So excluding the chip controls, you're at 78% growth, followed up by 79% growth, followed up by 76% growth. All of that while lapping essentially triple digit growth last year, over 100% growth in the same quarter as 1 year ago. And while the company is putting up, I mean, the guide for Q2 is $45 billion in revenue. So you're talking consistent and steady, durable, roughly 75 to 80% revenue growth on top of triple digit growth at massive scale, essentially $50 billion in revenue per quarter. I don't know if I've ever seen that combination of high growth, high scale, and tough competition with the lap, right? Because if your sales dropped 70% last year, it's pretty easy to grow 100% because they were down so much. But if you were up 100% last year and now you're up another 80% this year, it's just super impressive. Like the story there is ridiculously impressive. And to me, it says, okay, again, getting back to the central theme here, beyond the trade war noise, the secular growth themes in all of these exponential emerging technologies so strong right now, and obviously the mothership of that is artificial intelligence. Nvidia is seeing so much demand for its chips that they're essentially brushing off an $8 billion hit in sales because of trade tensions and export controls. That's sensational. That is amazing. And to me, what it says is everybody is in a rush to buy AI chips, AI chips, AI chips, and more AI chips. Of course, that's great news for Nvidia stock. I think Nvidia is fantastic in terms of the growth profile relative to the valuation. This is a company that is definitely, in my opinion, going to be a greater than 20% or 30% compounded EPS grower over the next several years. And I'm going to pull up the valuation look for you right now. Nvidia is trading at 28.5 times forward earnings. Of 5-year average is 40 times. I mean, we're at the bottom side of its valuation range in the last 5 years. If the growth story is not slowing down at all, that doesn't make sense to me. That means if you have the same growth numbers as you had in these last 5 years, if the valuation is at a 5-year low, that's a very attractive valuation and growth discrepancy that I think people should take advantage of. I think Nvidia is a great stock here and now. But beyond Nvidia, I think the story or the read-through for the entire AI industry is so darn positive because Nvidia is the top of the AI funnel. They sit at the top of the supply chain. Everything in AI starts with NVIDIA. You want to build an LLM, you want to develop an autonomous car or driving car, you want to build a humanoid robot, you want to build AI glasses, whatever it may be, you want to create some new automation software for call centers, whatever it is, it all starts with the same thing, buying NVIDIA chips. You got to buy those chips. Those chips go into data centers. Those data centers then power all these applications. Those applications then get adopted by consumers and proliferate throughout the economy. It all starts, the top of the funnel here are the chips. So if everybody is buying chips, it means a ton of money is flowing in to the top of the funnel. That money is going to flow down the funnel and positively impact all of the companies in the funnel, all of the stocks in the AI downstream universe. Wedbush, one of my favorite tech research firms out there, estimates that for every dollar spent on an NVIDIA chip, so every dollar that comes into the top of the funnel, it translates into $8 to $10 spent throughout the rest of the funnel, throughout the rest of the AI tech ecosystem downstream, whether that's building new data centers, buying new equipment to power and operate, maintain, and run those data centers, creating new applications that proliferate throughout the economy. All of that is downstream tech spending from an NVIDIA AI chip. $45 billion in revenue. That's the guide for Q2. Let's take Wedbush's numbers, $8 to $10 in downstream spending. That's $360 to $450 billion in downstream tech spending because of that $45 billion guide for next quarter. And that's in the face of an $8 billion hit from chip controls. That's wild. That's super impressive. That is the story that matters, not the trade war nonsense, not Trump and Xi going back and forth, not boxing gloves coming on between the judicial branch and the executive branch. Great political theater, not going to drive markets in the long term. What's going to drive markets in the long term past all this noise? The stuff Nvidia is talking about. Again, if everybody is buying their chips right now, it means in the next several years, people are going to be doing something with those chips. Making self-driving cars, making humanoid robots, making AI glasses, making new AI applications. Invest in that downstream. Invest in the top of the funnel. I think Nvidia stock's a great pick. 28 times forward earnings for what I see as greater than 25% compounded EPS growth in the next several years. Great profile. But also invest in the downstream. Invest in the data center operators, invest in the builders, the appliers, invest in the whole AI ecosystem. Go all in with AI with AI. That's the motto. At least that's my motto right now. Trade war noise, rearview mirror, look forward, it's all AI. That's what the NVIDIA numbers said to me, and that's why I'm not giving much weight to this trade war nonsense right now.
Gotcha. I do want to move on to some of that tech you talked about, but I have to ask, just listening to some of the news, do you think there's any credence to the idea that the chip controls and restraints placed on Nvidia can cause China to produce a competing company that could maybe take up some of this Nvidia's market share worldwide? I think one of the main stocks they talked about was Huawei. Do you think there's any credence to that idea?
I'm in the camp of, and I'm not saying I'm right or wrong. I'll just say in the camp that I'm in. I'm in the camp of we should get rid of the chip controls and let Nvidia sell to them because well, there's a few reasons. One, China's gonna do AI no matter what. Like it doesn't matter if we sell them chips or if we don't sell them chips. Like they're gonna figure it out. They have the manufacturing capacity to do it. So if we aren't the ones supplying them the chips, then yes, we create a stronger incentive for them to create a company that can supply their own chips. And that company could, with a
Hmm.
national interest from China with the support of the entire government, that company could overtake Nvidia globally for the supply of AI chips. So I think because of that, I think we should get rid of the export controls because in a world where we have massive export controls, yes, you're going to be like, oh, we're cutting off Nvidia's right arm, and then or not Nvidia's right arm, China's right arm, and they're not going to be able to make AI models. Like that's the argument, and that doesn't make sense to me because that's not true. Yeah, you cut off their right arm, but they're going to regrow it. Like that's sort
Yeah.
of how this works. They have the ability to regrow it. They have the biggest manufacturing capacity in the world over there. They have the cheapest labor force in the world over there. There's a reason a lot of American companies go over there to make stuff. It can be made more efficiently, it can be made more cheaply. So if we force them to do that, right now they're not all that interested in making their own AI chips because they're buying ours. But if we force them to get interested in that game because we're cutting off the supply, then I think that creates a situation where you could have a company, maybe Huawei, somebody over there that emerges as a very big global competitor to Nvidia. So then the long-term impacts for an American company are one, you lose the China sales, and then two, you got to deal with a big new nasty foe at the global level that could take business from, in Southeast Asia, could take business in India, could take business in Europe, could take business even from American companies, right? So I don't like the export controls. I think they should go away. I'm not saying I'm right or wrong here. That's just my viewpoint on it. I'm in that camp. Jensen Huang, obviously the CEO of NVIDIA, obviously believes the same thing that I do. Go through the conference call, you can hear what he's saying. So yeah, I mean, we'll see how it plays out. Right now, I don't think the chip controls are big enough to create that incentive. But if they get bigger, then you could create that incentive and you could have a big problem, in my opinion. And that's what we saw with DeepSeek, that
Yeah.
big AI model that came out earlier this year. That was made out of necessity, right? China would not have come up with that if it weren't for the fact that we did have export controls. Like if we didn't have export controls and they were just able to build on the same models and all that stuff as American companies, they wouldn't have had the need to go out and create this hyper efficient AI model. American companies didn't do it. Why? Because they have access to all these chips and all this spending and all this money. So why go out and create a more efficient version? China had a need to do that because they weren't getting access to NVIDIA chips, and they actually turned that need into a breakthrough solution that is, worried a bunch of big tech companies. So we don't want that to happen on the chip manufacturing front. I think that would be much more disastrous than just a model breakthrough.
Definitely. Yeah, DeepSeek was one of the first things that came to mind regarding what could happen with all the constraints that are happening. Um, yeah, that was fascinating. Thanks, Luke. I do want to move on to tech. So we have, a bunch of new tech trends, and I want you to discuss three of them for us this week. Two we've touched on already: quantum computing and eVTOLs. But I also want to throw humanoid robots into the mix. Those have been pretty hot in Silicon Valley. So I just want to have you dive in and give us, the lowdown, what we should be buying or what we should be looking into. Take it away.
Yeah, sure. So let me see if I can get Let's start with quantum. I'm gonna pull up my my quantum 4 index for you. Remember, we make these proprietary stock market indices, and so one of them is the quantum 4, which is the 4 pure play quantum stocks out there: IonQ, Rigetti, Quantum Computing, and D Wave. You can see we had this massive rally in the quantum computing stocks in late 24, came down during the trade war, and now rebounding. But recent trade war volatility has kind of taken some air out of this rally, and a pretty big drawback in these names in the last few days, really. What was it? The peak was May 23rd. So last week or so, we've had a big drawdown. This is a sector that's going to remain highly volatile, but has a lot of long-term potential. High risk, high reward. I think we've talked about it before. Quantum computing is the foundation of, or computing is the foundation of the modern economy. You change the architecture of computing from classical mechanics to quantum mechanics. You make those computers infinitely smarter, and then the downstream effects of that, you make everything essentially infinitely smarter, faster, more capable. So the potential value unlock there is absolutely enormous, in the tens of trillions of dollars, in my opinion. We're talking global economy size impact. The winner here is going to be a massive winner, but there's going to be a lot of losers too. That's how emerging technologies work. Think about electric vehicles. Remember back in the day, we had Tesla and Lucid and Canoo and Rivian and Fisker, and there were so many different ones, 2019, 2020, 21, that were all thinking they're going to be the next big auto company. And the only one that's really still kicking around today is, Tesla, Rivian, and Lucid are all kicking around, but Tesla's the only one that's really thriving. Canoo went under, Fisker went under, Lucid is really struggling, Rivian's doing okay. But anyways, there's massive consolidation in the industry. Same with social media back in the day, whole bunch of social platforms. Now you really only have Facebook, Instagram, TikTok, Snapchat's even dying. Twitter's kind of dying. So it's just, industries consolidate over time. As they mature, they consolidate around the few winners. Same is going to be true in quantum computing. So there's a lot of pure plays out there in terms of 4, I think, publicly traded stocks. Really, Arctic Quantum, ARQQ is another name in this space. It's a really speculative play. You have a lot of private companies. You have some big boys in it. IBM's really getting into it. Amazon's really getting into it. Honeywell's really getting into it. So I think that obviously not everyone's going to succeed. The industry is going to consolidate around a few winners. Who are those few winners going to be? Right now, in my opinion, IonQ is technologically the most capable. I think their trapped ion method is superior to other methods out there. It allows for miniaturization of these quantum computers at a level that the other technologies do not allow. They're commercially the most advanced, as in they have the most sales and most deals. Their papers make them seem like they're making the most progress, their academic papers or scientific papers. And I think the management team and their just engineers are the most talented in the space right now. So because of that, I think IonQ is like my leading horse in the race, but it's so early that it's still anyone's game. So that's why I think when you get into the space, you want to have a basket approach, hence the quantum 4 index. But hugely bullish on quantum. It's going to be highly volatile. They were just red hot. I would not chase quantum stocks now. We had the rally. The rally is fading. Do not buy the fade until signs of the technical bottom show up. They are not showing up right now. These are acting like falling knives. Do not buy them because they're really elevated and they're acting like falling knives. Wait for the knife to fall a little bit further and at least show some semblance that it's hitting the ground, and then pick it up. I think there's going to be a great buying opportunity here in the next few weeks, but not right now. Number 2, eVTOLs. Let me pull up my eVTOL index because I also have one of those. I call it the eVTOL 2 because there's really only 2 companies out there that I like, Joby and Archer. Those are the 2 that are launching in 26 in the Middle East. Archer actually got to deal with the LA Olympics in 28. That's really interesting in my opinion. I think anyone that's been to LA or lives in LA knows traffic is a nightmare in there. You add the Olympics in 28 and oh my gosh, I cannot even imagine how bad it's going to be. eVTOLs are going to allow, the super rich people, the VIP people, maybe even the athletes to skirt by the traffic, literally fly over the traffic, and get around town very quickly and efficiently. So I think that's really cool. I'm excited for these stocks. Like Quantum, they kind of had a big run. The post-April low, the rally we saw from early April to mid-May, that was a really risk on rally. A lot of the speculative stuff, that kind of long duration out there on the risk spectrum stuff, did really well. Quantum computing, eVTOLs, now they're coming back a little bit. But I think quantum has a lot more room to fall because it just got super hot and now it's getting, some air is coming out of the wheels. I think a lot of air has come out of those wheels before we found a durable bottom. eVTOLs, I don't think a lot of air has to come out because you have a more immediate catalyst. Quantum, it's like, what's the next catalyst? Like, we're betting on this long-term future, and I get that. I love betting on the long-term future, but I can't really point to something like, here, in 2026, this X is going to happen, and these stocks are going to go up. I can't do that in quantum because there's not really an identifiable catalyst on the horizon in the next 12 to 24 months. With eVTOLs, that's different. I got a catalyst. The launch of commercial operations in 2026 from, and maybe even late 2025 from Archer and early 2026 from Joby. Anyways, within the next 12 months, I have two identifiable catalysts for these stocks, which I think could get things going meaningfully in a positive direction. And that's why with eVTOLs, I'm a buyer on dips here. That's what I would be. I would be a buyer on dips, even short-term dips. I think these stocks are going to go a lot higher over the next 12 months. And then we have humanoid robots, which we're actually still developing our humanoid robot index. I don't have one fully built out yet, but yeah, that's the next big wave of AI, right? I think AI is going agentic, AI is going physical. With AI going physical, we talked about AI glasses, we talked about a new form factor for consumer tech hardware. But I think the ultimate kind of manifestation of AI going physical, I think everybody would agree here, is a humanoid robot, right? When you think of like science fiction depictions of AI, what is like the ultimate manifestation of that? It's a robot, a walking, talking humanoid robot that has AI built in and is, basically a human, an artificially intelligent human. That's what people are building right now. Big tech is all in with this. Obviously, Tesla has the Optimus project. That's first and foremost, I think the leading project in the space. The timeline there is 2025. They want to create thousands of robots that work inside of Tesla factories. 2026, they want to create tens of thousands of robots that they can sell to other factories. And then in 2027, they want to develop, a lot more robots. I don't know the exact number. They want to get to 1 million pretty soon on the production line, and they're going to sell to consumers. So 25 internal use, 26 external corporate use, and 27 consumer use. We know Musk has a history of being aggressive with timelines, maybe push that back a year or two or three. But the fact of the matter is, it is coming. The humanoid robot revolution is absolutely coming. It is going to be huge, and it's not just Tesla. Meta's making plays here. Amazon's making plays here. OpenAI is making plays here. Microsoft is making plays here. Alphabet is making plays here. Nvidia is making plays here. Jensen Huang is super bullish on humanoid robots. So everybody who's anybody in AI is making plays in the humanoid robot space. I think realistically, I gave you the Tesla timeline. My timeline, within the next 12 months, by summer 26, we will see humanoid robots doing useful things in a number of factories, not just Tesla factories, but a number of factories. Within the next 24 months, by summer 2027, we will see the first use cases of humanoid robots in the household. Very, very small, very, very selective, very, very narrow use cases. But nonetheless, I think we will see humanoid robots in people's households, like Jeff Bezos' household or Zuckerberg's household, right? I mean, the elites by summer 2027. And then probably by summer 2030 is when we start to see it on a more, not a ubiquitous level. It's going to take a while to reach ubiquity of humanoid robots, but on a level where it's like, okay, maybe 10% of the population, 5 to 10% of the population has a humanoid robot in their house by the summer of 2030. That's my realistic timeline on that. If I am correct on that, you're going to have a huge investment opportunity over the next 5 years to capture the supply chain of humanoid robots. The humanoid robot makers, it's going to be a big boy. It's going to be a big boy. It's either going to be, it's going to be Tesla, it's going to be Amazon, it's going to be Microsoft, it's going to be a big boy. There's going to be some alpha there, but not a ton of alpha because they're already $1 trillion companies. Where you're going to
Right.
get the real alpha, the real investment winners in the humanoid robot revolution is going to be in the robot supply chain. Who's supplying the parts for it? Because these robots are very complex. They need actuators to move the arms, kind of like humans with the shoulder movements and the elbow movements and the joint movements. So a lot of actuators involved there. Computer vision chips, because these robots are going to need to see the world around them and process and understand. So computer vision chips, cameras, sensors. Maybe there's some LiDAR in there. Maybe there's some radar in there. Not really sure. I mean, people are going about it differently, but a lot of humanoid robots, at least prototypes today, do have LiDAR sensors. They all have cameras, so camera suppliers could be a big thing there. And then just the processing chip as well, the AI processing chip. Nvidia makes them, so I think Nvidia is still going to be at the epicenter of a lot of this compute. So there's going to be a whole supply chain, probably a new supply chain really created as a result of the humanoid robotics revolution. And that supply chain is where you're going to find your real winners. Not Tesla stock, not Meta stock, not Microsoft stock, but rather in the supply chain for a robot like Optimus.
Amazing. If you're telling me by 2030 I could potentially have a robot that does my laundry for me, I'm all in. All in.
I
uh,
think it's entirely possible. Actually, this year in China, they're already doing it. There's what's the company? UB Tech, I think it's called.
yeah.
Um, they are debuting $20,000 humanoid robots to household in China this year. Now, when China releases something, it's always half baked and never that great. But the fact that they're
Right.
doing it in summer 2025 tells me that we can get a fully baked version probably by summer 2030. This is no longer a science fiction concept. This is reality. It is hitting the streets. It is hitting the homes as we speak in China. So it may sound outlandish to a lot of people. Humanoid robots in my house by 2030, you're joking, Luke. Like give me what you're smoking. I want some of that supply. But when you look at it in China, that it's actually happening. Again, I think the company is called UB Tech. Actually happening. They're deploying humanoid robots, $20,000 a robot to households in China this summer. All of a sudden, it makes that summer 2030 goal for America look very, very achievable.
Definitely. Wow. So, speaking of stocks, let's move on to the five exponential stocks that we have for this week.
Mm-hmm.
I think we're starting with VEEV,
Yeah, let's pull up the chart on. This one is going to be Viva
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 Systems.
Systems. You can see the chart here. Let me get the MAs on all these pulled up so we can talk about some of the technicals on them too. But as you can see, Viva had a massive week last week. It was earnings, so they're a software company. Um, they do kind of CRM stuff. Think of like a mini Salesforce. Obviously, a lot of AI applications with Viva. The stock had a very very um, strong earnings report last week. The stock jumped from 234 to 280. Zooming out and looking at the big picture here, massive post-COVID winner, obviously digitization of everything, right? Boom. Tech collapse, ouchie, consolidation for a while. Now just starting to get some upward momentum. When I look, just pure technical look on this, okay? Pure technical look. If I'm to draw a channel here, looks like we're top side of the channel. Okay, so maybe don't buy it in the short term. RSI 78. Definitely want to wait for it to come back a little bit. But this was a consolidation for a long time, right? I mean, this was the major low from back in March of 21. Consolidated for a while, unable to break above that resistance level. Last week's earnings, that was a powerful break above that resistance level. So yeah, short term probably overextended, but this one feels like a stock that wants to recover a lot of its post 22 tech crash losses. So the highs back there were 341. If we stay on this uptrend channel, we retake those highs. I mean, I'm thinking by summer 20, no, it's late 26. And we're back to 350 on this name. So not a lot of upside really if you look at kind of the time versus percentage basis. But nonetheless, I think this one is starting to act like it really wants to move higher. But in the short term, definitely extended. Wouldn't chase. But this is an example of the downstream effects of all that AI chip spending, right? I told you every dollar spent on an Nvidia chip means $8 to $10 throughout the AI tech ecosystem downstream from the top of that funnel. That's exactly what we're seeing with Viva, application software company developing new AI models to help their stuff out. I'm going through their transcript right now. There's just a lot of stuff about AI. So direct quote, Viva AI is a major initiative and off to a great start. Especially excited about the positive impact Viva AI can have on the life sciences industry. So they've launched new AI stuff. Adoption looks good. AI strategy, they're having agents. They're rolling out agents. They're seeing good adoption on that. They're using AI to really accelerate things throughout the life sciences and as the CRM aspect of the life sciences industry. I think that's really exciting. I think there's a really, really cool potential here. Just, upside basis, 280 to 350. Okay, cool. But over 12 months, I think we can do better. So I'm not chasing this one, but if as a good bet on AI, yeah, I think it's fine.
Awesome. Next up, we got Unity Software.
Oh man, Unity. So Unity had a big week, as you can see, but when you look at the long-term chart, oh man, makes you really want to cringe. Massive. Remember when the metaverse was going to be the next big thing? Post-COVID, boom, all the way to the moon. Just kidding. Metaverse is not going to be a thing. And this has not caught any semblance of an AI bid, right? I mean, look, where's the AI bid here? There's no AI bid at all. There's no tech bid here whatsoever. The stock is languishing pretty much around all-time lows. So nice bounce off all-time lows, but is it legit? A lot of times I'd look at this chart and I'd say, ew, no way, stay away. But
Right.
with Unity, I'm going to say the opposite. I think this is maybe one of the biggest hidden gems in the technology industry right now, because I really believe that there is going to be some massive convergence between artificial intelligence and virtual reality. They just make sense together. It's a marriage that makes a ton of sense. We've talked about it with the AI glasses. AI is ambient. It doesn't need to have this stuff. It doesn't need to be touched or interacted with. It's ambient. It observes. It's in your environment. It's integrated into your environment. It's about contextualized experiences, integrated experiences, contextualized understanding. That's VR. That is literally what VR, XR, AR, that's what those technologies are. Virtual reality, extended reality, augmented reality. And so I think that AI and VR, XR, AR, that's a marriage, that's a match made in heaven. Like if I were Hitch, I mean that's my winning marriage right there. That's the one I brag about to everybody. That marriage is coming. And it is going to be huge and it is going to change everything about the way we as consumers interact with technology, no longer through screens, but integrated into our own environments. And to me, Unity software sits smack dab at that intersection. It's got a first row seat to that wedding. It's the best man in that wedding because they have this real time 3D rendering engine. Between them and Unreal, it's back and forth. Who's better? Who's better? So that's the one risk is competition with Unreal. But Unity has a real time 3D rendering engine that is going to be perfectly suited for creating using AI to create integrated and contextualized experiences in your environment. Think if everybody has AI glasses, right? The whole operating system for AI glasses has to be different than the operating system for an iPhone because it's a completely different form factor, completely different way you interact with the machine, with the thing. Unity is going to be able to integrate its way into that OS as a company that allows experiences, holographic experiences, to be integrated into your real world environment. So the growth story here looks broken based on the numbers. The stock looks horrendous, but I think it's a wild card bet on with massive upside potential on the integration of AI and VR technologies to create some massive new form factor device that's going to radically change how consumers interact with technology. So I mean, I wouldn't go all in. I wouldn't bet the farm. I wouldn't,
Of course.
but I think Unity could be in the next 5 years one of the biggest winners in the stock market. Seriously.
Amazing. Now, speaking of AI glasses and things you put on your face, the next stock we have is Elf Beauty, the makeup company.
Elf. We used to like this one, and then we sold it in our model portfolios a long time ago. And you'll see why. I mean, look at the charts. Elf was a massive winner, beautiful winner off those summer 22 lows. Started kicking butt. They got that Gen Z marketing. They were super affordable makeup, increasing distribution in a lot of channels. They were a killer makeup brand that was doing everything right. And then when we got bearish, it was a technical call. Well, sales was slowing, or sales growth was slowing, but it was a technical call here. Look at this double top, classic double top. 220 hit the head, 220 hit the head, boom. Double top, and look at that double top ever since then. Massive crash lower, clearly in a breakdown. The bullish thing is we did just get earnings. They were better than expected. It looks like the tariff impact here might not be as large as feared. Because
Mhm.
remember, Elf, a lot of their they're the affordable brand in cosmetics, right? A lot of that affordability comes from the fact that they source stuff from China. So they are right in the crosshairs of the trade war, and specifically the US China trade war, which is arguably the most intense right now.
Mhm.
Existential threat to the business model, kind of, like seriously, kind of. They reported earnings that eased a lot of those fears, but did not erase them. So I think what you're getting here is a dead cat bounce. I do not think this stock is ready to go yet. I think the consumer is still a little bit challenged. I do not think that, if Elf is forced to raise prices, if supply chains do get disrupted over there, I mean, that's their selling point. They're cheap. They're cheap. They're cheap. They're cheap. If they're not cheap anymore, what are they? Not worth it. So I think that, the company is facing a lot of issues. The stock has been in a significant downtrend. Breaking above the 200-day is a positive sign, but I'm just not convinced quite yet. It needed an RSI of 85 just to break above the 200-day. That tells you how beaten up it was. So this is an oversold bounce. Now we're overbought. Give up some air. Let's see if they can defend the 200-day. Let's see how the trade war plays out, but I wouldn't be jumping into this one just yet. There may come a time to buy it, but I'm not waving the flag on that yet. I'm not saying go, 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 go.
Gotcha. Okay. On to the next. We got Box.
Great story around, again, AI downstream. Downstream AI, I think that's exactly where you want to be. And Box is proving that. They had a great earnings report last week, like Viva. And the story here is AI, 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 and more AI. So I'm going to pull up their conference call right now, their transcript, just so I can illustrate some of the AI applications that they are seeing. I think the stock was asleep and now it's waking up. And I think that's actually a really good sign. Again, don't want to chase it short term because RSI is 84, 83. That's not great. But here you go. Um, Strong. So it was strong earnings that got the stock going. First thing to say on the conference call. We had a strong start to fiscal 2026 with results reflecting continued growth in customer demand for Box AI. So there you go. The very first sentence in their conference call about AI. We saw strong momentum in customer adoption as enterprises look to Box to help them transform their AI-driven workflows around content. AI-driven metadata extraction, leveraging Box API for metadata extraction, powering diverse AI models through the Box AI Studio. Talk with over 100 customers, and they're all about getting into an AI first world and using Box to get there. So, downstream, 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 downstream. More people buy NVIDIA chips, the more money's flowing into the funnel, the more money companies like Viva are going to create AI applications, the more money that companies like Box, who are providing essentially data management for AI models, are going to see demand for their solutions grow as well. All about downstream AI. And again, that's why I'm so bullish when I saw that NVIDIA earnings report. I'm like, wow, that's a very, very positive read through for all of downstream AI. So get into downstream AI, get into companies like Viva and Box that are going to see these big moves because they are getting a lot of that beneficiary, or they are beneficiary of a lot of that downstream AI spending. So I do like Box if I'm thinking about it from a valuation perspective. I remember this being one of the more fairly valued names in the AI space. It's kind of been unloved for a long time, and now it's starting to get its AI boom. Yeah, so the valuation has gotten hot recently. I mean, 27 times forward earnings, but on EBITDA basis, I think it's a better way to look at this company. I mean, 15 times EBITDA, not that expensive. I think it's a double-digit grower, so I think Box is actually pretty strong here. Not like a super high conviction name. Like I love it, pound the table on it. Everybody go get some. But yeah, I think it's a good AI applier. I think it makes a lot of sense in the AI winning basket, if you will.
Awesome. All right, so let's move on to that last one. It seems to be almost in conjunction with the eVTOLs. We got Eve Holding.
Yeah, eVoling is one of those eVTOLs. Big week last week, but I mean, as you can see in the chart, this is one of those that had the SPAC in 21, and then kind of was late to the SPAC boom and never really got a bump and struggled around and then got destroyed in 22, 23, and then now is trying to recover a little bit. The chart doesn't look bad. The chart does not look bad, right? I mean, we came down big time, flat line, clearly put in a bottom. We've retaken the 200-day. Retook it once, fell right below it, retook it again. That's pretty positive action. 200-day is now sloping higher for the first time since God knows when. So the action doesn't look bad. We do have that big technical top right here around $6. So I'd like to see it take out that before calling this a technical breakout. But fundamentally, I'm just not in love with Eve because I think there are two players in this space. There's Joby and there's Archer. They have the best talent. They have the most funding. They have the best prototypes. They have the most advanced when it comes to FAA certification. They have the most visibility to commercial operations launch in the next 12 months. If we're looking at eVTOLs, Joby and Archer are just better options. So I'm not sure why I would go out to Eve. I mean, Joby and Archer are still pretty cheap stocks in terms of like evaluation relative to total addressable market, total potential. I don't know why we'd go out and look at Eve. I think Joby and Archer are fine enough for exposure. There's a reason why when we created our eVTOL index, we only did the eVTOL too. We didn't include Eve because I just don't think, I mean, when you look at tech, when you look at commercialization, you look at funding, you look at team, I don't
Mm,
think Eve has what it takes to compete with Archer and Joby at scale. So not bullish on Eve, but very bullish on Joby and Archer.
amazing. All right, great selection of stocks this week. Now, Luke, I know you texted me this past weekend. I know you got a pair of AI glasses. I'd love for you
Oh,
to dive into that. There we go.
oh, they're hard to take out because they have the charger in them. So it has like one of those like those connection ports.
Gotcha.
All right. How do I look?
It's a good look. Good look. Looking
How do I look?
sophisticated.
Do I look smarter? Do I look like I know more about technology?
Yeah, just a bit. Really putting the futurist and tech futurist.
Listen, I just got these. I just got these last night, and I just started playing with them. So we'll talk about it more next week for sure. But in playing with them last night, I have really enjoyed them. They are. I used to have like these Sonos glasses or something. I forget who actually made them, and they're just like speakers that could do phone calls and play music and whatnot. And obviously these can do that. But the cool thing about this is there's this whole app, the Meta AI app that you can download. And it's on your phone. And it,
Mhm.
it pairs to the glasses, obviously. And the pitch is, and this is what I'm gonna find out this week if the pitch is true. The pitch is that Meta AI can become your personal AI that's in your ears, basically,
Yeah.
on your face, ambient technology, right? And the pitch is that Meta AI it can leverage all your Facebook data, it can learn about you, it can find out, you live here, you like this, you do this at this time, et cetera, et cetera. So I'm going to experiment with that. I'm going to really let Meta AI learn everything there is to know about me and see if, as a result of that, it does become a personalized AI on my face. So, that experiment we will conduct this week. I'm going to have more for you on that front next week after a week of kind of learning with these glasses. But for now, good speaker quality. The AI is cool. Functionality is all controlled right over here, volume up, volume down. You can tap to talk to it, or you can just say I'm not going to say it because I don't want to talk to it right now, but just say, hey, META. You guys got it, right? And then if you want to record something or take a picture, there's a little button right here. You take a picture. If you want to record, you hold it and you just watch things. I haven't tried that feature yet. Well, I mean, I haven't tried it on something that matters. Maybe I'll go to something this week and I'll use the record feature. I'll let you know how usable and fun that is. So just got them, still learning about it. Gonna do a lot of experimenting this week. We'll talk about it next week. This is not what's going to change the world, but this is, I think, the first step towards something that is going to change the world. Let's see how big of a first step it really is. Answer coming next week.
Awesome. Yeah, I can't wait. Can't wait to hear more about those glasses. They do seem pretty slick. And just to wrap up this week, don't focus too much on the day to day. We're looking forward. We're being exponential, and we're going all the way. You got any closing remarks, Luke?
Yeah, I mean that's a great way to put it. It's just the day to day is going to be noisy and volatile with all the politics and the trade war and the tax cuts and all those bills and all that stuff. But it's like remember that zoom out, zoom out, zoom out, zoom out, zoom out. First real web browser launched with Netscape, I believe, in late '94. I think it was in late '94. Since then, we have seen, well, we had 9/11, we had the war in the Middle East, we had the great financial crisis, we had a sovereign debt crisis, we had a commodity price crisis, we had a Fed-induced stock crash of 2018, we had a global pandemic and lockdowns. We had the highest inflation we've seen since the 70s. We had the fastest rate hiking cycle we've arguably seen ever based on size and velocity. And we've had a massive tech stock crash. We've had a lot.
Right.
And through all of that, what was the one thing that remained true? This goes back to the reason we're doing this podcast. The exponential technological progress of the internet. The internet expanded and it grew and it grew and it grew and it grew and it went from desktops to PC to laptops to mobile to the cloud, and everything just expanded and it grew through the noise. And if you were able to stay the course and invest in internet, companies like Amazon and Microsoft and Netflix through all the chaos, yeah, you made out like a bandit. I think the same is going to be true with AI. There's going to be so much noise over the next 10, 20, 30 years, especially as it relates to AI-driven changes. Yet through it all, I think AI itself is going to continue to grow and improve, and AI stocks are going to be massive winners. It doesn't mean ignore the short-term noise. It just means pay attention to it, but do not change much unless that short-term noise becomes really, really loud. And right now, it's not. So I say ignore it. Pay attention to the AI stuff, and that stuff is loud. And let's find some opportunities in this recent weakness.
Fantastic. Great stuff. And with that, that's another episode of Being Exponential with Luke Lango. I'm your host, Brooke. And we'll see you next week.